here tonight. Okay, it should be recording. So in case you don't want to appear on the recording, it's, you just don't have to ask questions aloud here. We still have Slido for questions. So, that's completely no problem, or shouldn't be. Great. That was technical remark number one. Technical remark number two is that you can see a Slido code in front of you. Once again, as last time, it won't be for quizzing you or anything like that. It's just a channel through which you can ask anonymous questions if you want to. I have it open here on my smartphone next to me. So if you want to ask something and don't want your name appear next to the question, you can use that channel. I will be checking throughout the presentation, and I think we will have a lot of time towards the end to discuss any questions you might have. So that's all. The title slide will be here on for some time. So I guess you can use it to connect. You can use their website or Slido app. Okay, I guess that makes the technical things sorted out. Let me move to the topic then. Today we will talk about investing, which is like one of the most natural and the more complicated things people ask us about. But I think the bottom line of today's lecture will be quite simple. See, in a sense, investing is like tennis. I actually heard this analogy like last week, and I really, really like it. So the first time I heard this analogy, it went like this. In tennis, you have a couple of really, really strong professional players who have been playing for many, many years. And those are the ones who can strategize and attack in games and win by actually placing the ball correctly and being more aggressive and strategizing in ways they approach the games. However, when you look at amateurs, so people who aren't like professional tennis players, but if you have a group of, normal people going to play tennis on a Sunday afternoon, usually the winner won't be decided or won't be the party that will be like the more aggressive or more strategic one, or trying to approach the game in a more aggressive and professional manner. It will most usually be the party that makes the fewest mistakes, right? So that doesn't make an error during the game and doesn't lose many exchanges in that way. And investing is very, very similar. In the world of investing, there are two ways in which you can approach it. Either you can try to be the smart person, so try to imitate those very, very professional investors who like analyze charts and try to predict the future and try to pick which companies will do the best. Or you can take a more defensive approach and try to focus on not making mistakes in your investment journey. And the bottom line of today's presentation will be that if, ordinary people who aren't very professional in this field try to take the smart approach, right? Try to be very aggressive and very proactive about their investment strategy, try to analyze charts and predict the future, most often this will end up in making mistakes and losing money on investing. Whereas if you take the more relaxed approach, where you focus on avoiding mistakes and taking like a more passive approach to investing, you are more likely to succeed, right? So that will be like the main idea of this presentation, similarly to to a game of tennis. Before we delve into what that even means and what does it mean to take a relaxed approach to investing that focuses on avoiding mistake, let me briefly introduce where we are, myself, and where we are within this topic. So for those of you who don't remember from the last time, my name is Shimon. I'm from a company called Finax, which is a Slovak securities broker dealer. Our main product is offering managed investment portfolios to clients suited for various financial goals and savings or investment goals they might have. The main areas I handle is external communication. I handle product and investment portfolios, and I also work with corporate finance and company budgeting and accounting, reporting. So those are the areas I do. I believe that those have given me like enough of an insight to be able to understand how our investment products work, how they are created, how they are handled by clients over long periods of investing. And I believe that I will be, or I will try to pass on some of that knowledge to you in this evening lecture. This lecture or this webinar is a part of a longer series called Finax Financial Wellness. You are watching lecture number 2. There are 5 lectures in total. So last time, I believe you should have the slides and the recording made available to you already, was about some healthy personal finance basics and building up an emergency fund. So that was what we discussed in the last lecture. What we'll focus on today is investing, right, as the foundation of wealth building. So we'll delve into the more complicated stuff that follows after you already have a budget and after you are capable of setting aside some amount regularly each month. And after you have an emergency fund, that should come before you start investing in more, risky ways. Then we will also have 3 more lectures together. We already planned for that. So we will talk next time. We'll talk about securing a decent pension. We'll talk about good and bad debt. And we also have 1 lecture dedicated to finances for kids. So how you can approach finance from the standpoint of a parent willing to, give or develop healthy financial habits in their kid, or maybe save up some money for them. However, today's agenda is investing. So let's get right into it. When you think about investing, I like to think about it as building like a Lego construction, right? So when you are building a Lego construction, you have a lot of individual smaller Lego bricks and you construct them into one larger one, right? You combine them in some areas and you create a larger construction that has some attributes, right? And investing is very similar. In investing, you will have a lot of Lego bricks to choose and you will combine them into something which is your portfolio, right? So you have a lot of Lego bricks, such as stocks, bonds, and similar things you might have heard of. And investing is about picking those that are right for you, picking a lot of them, and combining them into like your investment portfolio in which you have invested your savings, right? So the first thing we need to understand when we want to select a good portfolio or invest in a reasonable way is what we can even invest in. What are the individual Lego bricks from which we can build up our own constructions, right? And you have several basic types of what you can invest in. The first Lego brick that you can invest in are stocks. You probably heard this. It's probably the most generic thing people have associated as the word with investing. But what is it? Stocks are ownership stakes in companies. So when you buy a stock, you become a co-owner of a certain company. Literally, like you own a very, very small percentage of that company. And with that comes a very important right, and that is the right to participate in the profits of a company. So whenever a company like earns some profits and wants to distribute them to the owners, it has to distribute to sort of all owners, right? All holders of stock. You cannot just exclude some randomly. All owners have a right to participate in distributions of profits. So this means that stocks are sort of right to participate in profitability. And that means that when companies are successful and when they make profits, when they make more and more money because they make products that people want to buy, stock prices will usually rise because, everyone wants to buy them. Who wouldn't want to own companies that are successful and then makes their prices increase? So when companies are successful and are making profits, people who hold stocks will probably make money because stock prices will rise. However, there's also the other side, right? No one guarantees that any given company will be making a profit. Companies can struggle to make money. They can even lose money because they invest in projects that turn out to be failures. They enter markets where where people aren't interested in their products. They can spend a lot of money developing a product that is useless, that people don't want to buy, and lose money in that way. Or they can be pushed out by cheap competition from China. Anything can happen, right? That was before the tariff era. Now probably in the US they are more protected. Anything can happen. Profit is not guaranteed. And that is why investing in stocks is risky. Because if companies will be struggling, will be pushed out by competitors, will be losing money, then stock prices will decline. And that means that you can lose money by investing in stocks. So that is why usually when you hear about investing in stocks, you will hear that you can make money, especially if the company is profitable. But there is also a risk. And the risk is materialized in the property that companies are not guaranteed to make profits and they can also lose money, right? So that is when it comes to stocks. Stocks are not the only Lego bricks you can choose in the universe of investing. The second type of what you can invest your money in are so-called bonds. So bonds are something like loans of money bound in a piece of paper that you can invest in. Let's call it, or bound in a security that you can buy. It works like this. Imagine I'm a company or a government that wants to borrow money. I'm a government that wants to build a hospital or build a highway, but I don't have enough money from my taxes. So I decide to borrow that money. I can borrow that money by creating a piece of paper and selling it to an investor, right? That investor will buy that piece of paper from me, so I will receive money, and I can use that money to build the highway or build the hospital that I want to build, right? That piece of paper contains a promise that I sign, right? And that promise is to make some regular interest payments, just like when you have a mortgage and you make some regular repayments to the bank. It works in the same way. You will just make some regular repayments to anyone who owns that piece of paper for a specified period of time, right? That period of time can be a couple of months to 30 years, anything. So again, just like when you have a loan, you can take out the loan for 8 years if it's some consumer loan, or a mortgage, which is usually for 30 years, or it can be something even more short term, right? So over that period of time, you will be making some regular fixed payments. And after that time lapses, you make one final payment and the bond ceases to exist and you don't have to make any payments anymore, right? So this is how a bond functions. And via these regular payments, you repay the amount that you borrowed and also some amount on top of that as interest, which represents like the reward for the investor who lent that money for you. So these are essentially bonds. They function like regular bank loans with some regular payments. Now, bonds are slightly less risky than stocks. Why is that the case? The reason is that, first of all, bond payments are fixed, right? You can say in advance what they will be. It won't be like, profits of companies, they are impossible to predict. They are different from year to year. It's impossible to say the exact number, right? With bond payments, the amount is written in the promise, right? So you can like anticipate more easily what to expect. Also, companies usually try to make, or companies and governments usually try to make their bond payments. This is because if you fail to make your bond payments, you will enter a so-called bankruptcy. And for example, for companies, that means that anyone who holds your debt, such as investors or banks, can seize control of your company. And that also usually means that they fire the entire management of the company and replace them with people that they find more suitable and more competent, right? Almost always the entire management gets fired in a case of bankruptcy. That is why managers of companies try to make interest and bond payments not to lose their jobs, right? So usually bonds are a more certain stream of income than stocks, right? It's more predictable, and usually companies try to make it. Even if they are losing money, they still try to repair their debts, right? So when stocks are declining, bonds can still like be making those payments. However, that doesn't mean that bonds come with no risk, right? It can happen that a company or a government will just not have enough money to pay off their debts, right? And in that case, bankruptcies happen. Like you have probably heard that at some points, bankruptcies did happen. They are just much rarer than some declines in stock prices, right? So even by investing in bonds, you can still lose money. That's very important. It's not like a guaranteed investment that is where you cannot lose money via bankruptcy. But regardless, they are less risky than stocks, and that also means that usually they earn lower profits. But we'll talk about that later on. So those are the first two Lego bricks that you can pick from and put together. There is also a third type of things you can invest in, and that is called alternative investments. Now, this is a very wide range of things. Almost everything falls here. That is real estate, houses, cryptocurrencies, precious metals like gold or silver or other things, commodities like oil, and other similar things that you can invest in, right? The reason these are called alternative investments is that they are traded on markets that are outside of the traditional stock and bond markets. And these markets are usually less regulated, which means that there are fewer regulations that try to protect investors by, for example, mandating the companies that issue these investments to publish certain information that is necessary for investors to judge whether this is a good investment or not, right? So there are fewer investment protections, less regulated, which means they are usually even riskier than stocks, but with potential of making earning higher investment profits. So this is like the third type of things you can invest in. Now, so these are the Lego bricks we can choose from. There is a very important relationship in finance, which usually holds, and that is depicted in this chart, right? Usually, the higher the return that you can earn from an investment, so higher the potential profit, right? The more risky the investment is. So if investments are relatively safe, they also usually don't make a lot of money. The riskier they are, the more money they are sort of expected to make, right? So a couple of things to define here, right? What is this risk? This risk usually means how much the value of the investment, so let's say you invest 100 euros in it, how much the value will fluctuate. So how sharply it will go up, how sharply it will go down. And if some economic crisis happens or something like that, the risk usually also captures how much the investment declines. You know, if something declines only slightly by, let's say, 5%, then it's not that risky. If something in times of crisis tends to decline by 50% in value, that's super risky because you can suddenly, lose half your money by investing in it. So this is risk, how sharply the value fluctuates and also how deep the declines are, right? And usually, you have this relationship. The higher the return, the higher the risk you might undertake to earn that return. Usually more risk, taking on more risk of value fluctuations and of declines happening is the price you have to pay for earning a higher investment return, right? Now, what I want to say by this chart is not that any of these things that you can see here in the chart is a bad investment in and of itself. Some investments, the important thing is that different investments are suitable for different goals, right? So for some investment goals, you actually should take on more risk and exchange it for earning a higher return. With other investment goals, you shouldn't take much risk because you cannot afford it, because it is like not responsible to gamble and risk too much with those kinds of investment goals. And for those, something that earns less money but is less risky can be more suitable. So the important thing here is that all of these things you can see here, even the high risk things, can help you with different goals. You just have to know for which goals, which of these things are suitable. What is a pity in Slovakia, especially, or in the inter-central European region, is that people tend to, avoid risk in general, right? They tend to hear the word risk, and that sounds like something bad because no one wants to risk their hard-earned money, and that is completely understandable. Which means that here in these regions, we usually don't invest in the things that are more risky, right? And limit ourselves to cash in the banks, like Slovaks, for example, hold giant amounts of cash in their banks, or maybe to some bond funds, even if we save for pension or something like that. The problem is that for some goals, it's not very suitable to invest in these because they don't earn much money, right? Because they don't have very high returns, and that means that oftentimes inflation can eat away from the money, and essentially by not earning the higher return, people are losing money uselessly. So what we are trying to teach people here is to sort of explore the full investment universe and see where riskier options that earn higher returns are a reasonable option. Not always, but for some goals, such as saving for retirement, which you will be doing for many, many decades, and you don't have to care what happens with the value of the portfolio and how much it fluctuates and goes up and down in the meantime. For those goals, very long-term ones, investments like stocks are much more reasonable than holding money in the bank, right? So this is what we will discuss now. In the next couple of slides, we will learn where and with what kinds of goals different kinds of investments are reasonable, right? So let's start by bonds, because last time, for example, we discussed, cash investments. That was in the previous lecture, where we said that when you have an emergency fund, you shouldn't actually risk with it much. You shouldn't invest your emergency fund in stocks. It's better to find like some high interest saving account or maybe some money market mutual fund, which usually just earns the central bank interest rates. So it covers a portion of inflation, but you don't risk the money much, right? So that was already covered in the last lecture. Now, another thing you can invest in are bonds. So bonds usually are not that risky, but they earn lower returns. When is this reasonable? So this can be either reasonable when you want to be cautious. So, some investors just know that psychologically they wouldn't be able to bear, just bear seeing the value of their portfolio fluctuate up and down very sharply, right? They want to avoid risk. So for those, especially if they want to maybe try investing at the beginning, for those who want to avoid risk in general because they don't like it, bonds may be a more suitable option. But the main point probably, and the main distinguishing factor to determine whether bonds are a suitable thing, is if you will need the money relatively soon, right? If you know that you will need the money relatively soon, you shouldn't be risking much with the money. And so, investing in into high risky investments. Why? Because if you will need the money soon and risky investments decline in value, you will not be able to wait until the economy recovers and until the value of your investment grows again. So that means that you will just not have enough money when you reach your goal because some economic crisis happened, and the value of your portfolio declined, right? So in these cases, when you will need money soon, it's reasonable to have bonds in your portfolios and maybe build the portfolio and base it mainly on bond investments, right? What does it mean that you will need money soon? In general, this means that you will need it within 3 or 10 years. So imagine a situation like this. You have a child and you know that in 6 years, that child is going to go to a university or go, gain tertiary education somewhere, either here or abroad, right? And you know that they will need some money that you have saved for them then because because they are living and they will need to pay for their living costs. So for this investment goal, it's reasonable to keep the savings that you have for them for university in a portfolio that contains mostly bonds, right? Because if you held it in stocks and a massive decline happened in a couple of years, and in 6 years the portfolio would be in red numbers because stocks declined because there was a crisis, you cannot just tell the kid to wait for a couple of years until stocks recover and go to a university then. They probably want to go at that time, so you will need the money in 6 years. Similar thing is when you are buying a house and you are saving up the 10 to 20% of the purchase price that you need because the bank mortgage won't pay for the full price of the house, and you know that you will be buying that house and taking on that mortgage in roughly 3 to 4 years, then you shouldn't also risk much, because if you put everything in a risky investment such as stocks and stocks declined rapidly in 3 years, you would not have enough money to buy your house, right? So because you need the money in 3 or 4 years and you don't want to delay purchasing your own home much beyond that because you plan a family or something like that, you also should have mainly bonds in your portfolio, right? And yeah, sometimes the third reason why people add bonds in their portfolios is just in general to have some insurance against stock declines, because sometimes, not always, but sometimes when there's a crisis and stock prices decline, bond prices tend to increase because people consider them to be like a safe haven assets. So, big investors, big funds that invest shift money from stocks to bonds, and that makes bond prices increase, right? Especially in times of uncertainty. But it's not a guaranteed effect, but it tends to happen in some economic crises. So it can also serve as an insurance against stock declines if you also have stocks in your portfolios. But crucially, the bottom line of this slide is that if you will need the money within 3 to 10 years, roughly, you should have some bonds in your portfolio. Usually you mix them with stocks in various proportions, right? For these kinds of financial goals. And don't worry if you don't know, the exact proportions, right? So let's say you want to buy a house in 5 years. What percentage of my portfolio should I put in stocks and what in bonds? Don't worry about that too much. There are companies that can advise you with this at the current stage. Essentially, it's one of the things we do as Finax. So when, for example, clients come to our website and want to start investing, we usually ask them what the goal of investing is, in how many years they will need the money, for what goal, how much they want to save up, how much they have, what their situation in the families and stuff like that. And based on that, our algorithms recommend like the optimal split between stocks and bonds. So let's say it recommends to invest 40% in bonds and 60% in stocks, something like that, based on some expected developments and riskiness of bonds and stocks, right? So you don't have to analyze the data yourself. You can ask companies to do it for you. These companies are usually called robo-advisors. Finax is one of them, but of course you don't have to only use us. There are other competitors who are also offering similar services. The key keyword there is like robo-advisory firms. Those are the ones that pick optimal proportion of bonds to stocks for you if you are investing for, let's say, 3 to 10 years, right? But in these goals, it's reasonable to have some bonds in your portfolios. Now, let's move to the more risky investing, right? So I said that for some goals, it's actually unreasonable to hold these bonds and avoid risk, right? Um, and that, in general, is if you won't need the money in 10 years, right? If you will only be using that money later than 10 years from now, then it's usually reasonable to invest most of your money in stocks. Why is that the case? Let's discuss that. Why is it worth the well-known risk of investing? The reason is that stocks historically have been probably the most reliable investment tool to beat inflation. So to beat rising prices. When you are investing, when you are saving, you usually want your wealth to grow faster than prices so that you actually multiply your wealth. Because inflation is eating away from the value of your money. If everything costs more and more, that means that each euro in our savings can buy less and less things, and that means it's losing value. So if you want to actually appreciate your wealth, you need to earn investment profits that are higher than inflation. And you can see this is just data from 1926 to 2020. The average per year investment profit that stocks earned beat inflation by a pretty wide margin. And it's logical because when prices rise, that just means that the products that the companies whose stocks you own, their products prices are increasing, and that means that the earnings of the companies will also rise by inflation because it's just the price of what they sell, right? But plus companies also increase their productivity, create technological innovations and stuff like that makes them sort of profit even more than inflation. But it's a pretty logical protection from inflation, right? So stocks earn high profits, and you can see it on the chart here. Even more so than bonds or gold or real estate, they usually tend to have over long periods slightly higher profits, right? However, and you can also see it in this graph. So this is the graph of 500 of the combined value of 500 largest companies in the United States. The reason I am using United States and not the world is that the US just has the longest period of data covered. The rest of the world usually wasn't that good in keeping track of their financial data. So we have a lot of very high quality data that go very far in history in the United States. So just to illustrate, this is something like the value of the total US stock market, right? The combined value of their 500 largest companies. And you can see that these are 200 years of data, right? So that's pretty long, right? And you can see that the value of those companies, so essentially the stock market, has been growing over that long value. Why is that so? What makes the value of stocks rise in the long run? The main reason is that, as I said, stocks are a right to participate in profits. They are a portion of profits, right? And the thing is that over the long run, the profitability of global companies is gradually increasing. That also makes the stock prices increase. There are several reasons why profitability is increasing. The first of them is some sort of scientific and technological advancement and innovation that allows society to be more productive. That is, to make more products given the same amount of inputs, given the same amount of human labor put in, given the same amount of, I don't know, maybe some materials and things, and sort of allows us to turn those inputs into more and more products, right? And you can see that on the timeline here, right? So somewhere in the beginning, in the 19th century, around the left side of the graph, sewing machines that allowed the creation of the first sort of companies for textile in the UK were created. Later on, you had other innovations, such as, towards maybe the right side of the chart, you will have personal computers, you will have calculators, you will have the internet, all of these things. You will later have smartphones and similar things, right? So all of these things allowed the world to be more effective in the way it produces stuff, right? And that means that companies taken in total can make more money because we can just produce more things given the same amount of hours worked, right? And that means that profits are increasing and then stocks are also increasing. And this technological innovation essentially continues all the time, right? Quite recently, we had the advent of AI, right, which also enhances productivity. And there was like a stock market value increase after that. That would be somewhere towards the very, very right side of this chart. Another reason why productivity is rising are rising educational levels, right? So at the beginning of this chart, almost no one had university education, and the entire Europe was working in agriculture on fields, right? Later on, we managed to, spread universal education and get more people educated, and that means that they work in jobs that sort of pay more money because they require higher education, they require more skills, but they also create higher added value, and that means that these people then have higher incomes and can spend that incomes that again creates profits for companies. So the more people we have in the richer educated classes, the more added value they create, and the more they also spend because they have more money, and that again increases profitability. And that like rising education levels, those are still continuing today, right? Just imagine how many people in India have grown from sort of poverty or extreme poverty to being at least middle class and being able to at least access high school education, right? Same in countries like Rwanda in Africa or similar things. So the more people there are rising to middle class, the more, educated people you have with higher incomes, higher spending, that again increases the profitability and productivity of the world. So despite all the negative news, the world is making some advances, and usually that gets in one way or another reflected in the global profitability. So owning stocks is like a way to have a cut in that progress. However, that's from this chart, it seems like it's very easy. Like you just invest, and it will be a straight line up, and there will be no sort of complications on that journey. But that's a very false image. And it might be caused by this being 200 years of data. So any given year is very small fraction that. So let's zoom in a bit. What you can see in this chart, focus first on the red dots, right? The red dots is the maximum decline into which that same stock market that was depicted here, right? So the US stock market, the combined value of almost all US companies, or all the large ones. And the red dot is the maximum decline into which this stock market got in each given year. And when you look at it, you can see that it declined by, at least some amount in each given year. So stocks rise in value, but they also decline. When any bad news happens, when companies start struggling, when an economy slows down or economy is weak, or when even larger crises happen, such as the crisis that happened after Russia invaded Ukraine and there was inflation and expensive energies everywhere, stocks decline, and they can decline a lot. Just observe, the ranges. You can see that a lot of those dots are around minus 20% or minus 30%. In some very, very dire situations, they can even be minus 40 or 50%, right? So that means that if you invest your wealth in stocks, it can happen, and it probably will happen in at least at some point in our investing journey, that 25%, so 1/4 of your savings will just disappear because stocks will decline, right? So that means that if you have 10,000 euros invested as your savings, you will lose 2,500 of that, then it will not be there in your account anymore, and you will see a big red arrow there, right? So these declines, this stress that comes with negative news that happen all the time, it's an inherent part of investing. However, there's one very important thing to note here. Many people think that when they invest and a decline like this happens, 1/4 of their money suddenly disappears, that automatically means that there's something wrong with their investment, that bad things are happening and bad things should be avoided. So they run away, they sell their investments, they panic, and they don't ever want to see that again. However, for investing, this risk and these declines, it's not a sign that it's wrongly set up. It's an inherent part of investing. Some people call it the price you have to pay for admissions into the world of investing, right? And that can be illustrated by looking at the blue bars, right, that you can see in the chart. So the blue bars represent the final sort of result, so profit or loss depending on whether it is above zero or below zero, that the stock market recorded in that given year. And what you can see is that most of those blue bars are above zero. So in most years, stock market ended up making money in the end, right? That doesn't mean that decline didn't happen at some point over the year. The market just declined and then recovered, and in the end recorded profits in that given year. In some cases, it had losses. You can see that the blue bars sometimes point downward, so that means that there were losses in a given year, but then later on became profitable again, right? So you can maybe see it when we zoom back here. You can see that sometimes the line goes down, but always this crisis is overcome and the markets come back growing again. That is because over the long run, we make progress and we make technological innovations and all things like that, right? So the fact that a decline happened doesn't mean that the stock markets didn't recover. You just had to be patient and you had to wait until stocks started growing again, right? So if a 25% decline happened, the best thing you could do, looking back here, is just patiently wait until the economy gets better and until stocks start growing again. The worst thing you can do is panic and sell everything off, right? So, on your investment journey, the best mindset to go into it when you invest in stocks is sort of to not view declines as something that means I have made a mistake and I should run away. It's just something that happens. And you should be counting on it happening if you decide to ever invest, right? On average, declines by 20% historically have happened every 4 to 5 years, right? So if you want to invest throughout your life, such as, for retirement, you should be preparing for decades, like 30, 40 years of investing. You will experience several, like you will be able to count several instances of these deep declines happening over your life. So it's not something that can be avoided. It's something that you have to experience if you want to invest. And the best thing to do is just to wait for economic recovery, right? And sort of not panic. But here, many people ask another logical question. They ask, okay, I see this chart. I understand that it grows in the long run. I understand that I have to be patient. But if stocks start declining, right? If a crisis happens, isn't it best to just sell and then buy back when the situation is better? Because maybe in the meantime stocks will decline and I will buy back when stocks are cheaper and then only experience it rising, right? And the answer is no. The answer is no, because many times we feel like everything is super bad and like everyone is super pessimistic, and the news are filled with very bad news. Yet stocks continue to rise for some reason. And let's illustrate it on this beautiful picture. These are bad news. Everything that you can see here is something that can be interpreted like an economic catastrophe is happening. This is the development, again, of the US stock market, so 500 largest companies combined together in the US, from March 2009 until September 2021. So that's a lot of time. That's more than a decade of stock market development. And you can see that there were many, many bad events happening in the meantime. Just read some of them. US government shutdown. The US doesn't have budget and cannot pay its federal workers and stuff like that. Ebola happening, Brexit. Like the EU has a member leaving for the first time in its history. Shutdown again, a pandemic, after which like a sharp decline actually happened. Second wave of the pandemic there. All of these are super bad. And I bet you that if you were there and were invested and were reading some economic media, you would be reading a lot of experts saying how a recession is coming, how everything will be bad, right? Yet, for some reason, stocks continued rising. And that is because if everything, is already in the media and the situation already seems bad, usually this means that it's already reflected in the stock prices. Because stock prices are usually determined by those, professional tennis players. Those are the investors who are like the big names. multi-billion-dollar hedge funds on Wall Street that have teams of analysts who studied at the best schools in the world and have supercomputers to aid their calculations, right? Those people get information sooner than you do, right? Because they have people to monitor it. They have literal satellites to see how filled parking lots are in front of Walmart to forecast how much they will earn in that given quarter, right? So these people usually know about things before you, and they will trade on that information, sell or buy stocks before you. So when something is already out in the media, usually this means that it's already reflected in the stock prices. And if people wanted to panic, stock prices have already declined before. So information that is out there in the media has a zero value in predicting what will happen in the future, because all the information is already reflected in the stock prices. Stocks already declined, or they already rose, and whatever will happen in the future will be based on information that is not known yet. So you cannot know it. So, using anything that is already in the media usually has a zero predictive value. And you can see it here, right? A lot of bad news saying nothing about whether stocks will decline or rise in the future. And because stock markets usually rise, as you can see in the long-term trend, actually, most of the times you hear bad news, nothing will happen and stocks will continue rising. So then what happens to people who are overly pessimistic and just sell because they think stocks are definitely going to decline is that they just miss out on investment profits because, because you could sell at the beginning of the graph and then see 10 years of stock market growth and just miss out on it. So the best thing is to stay invested. And in case a decline happens, which will happen many times on your investment journey, just patiently wait until it recovers, right? And don't respond overly pessimistically, right? The reason you should do this, you should avoid trying to predict what will happen in the future, is that if you miss out, so if you sell an investment and decide, I'll see whether stocks go down or up or down, and then I'll maybe buy back. I want for the situation to be a bit calmer. Is that if you miss just a couple of a very, very good days in the stock market, you can lose most of the profit that is out there to be earned. What you can see in this chart are a couple of numbers, right? It assumes that you had 10,000 US dollars, right? And you invested it in the S&P 500, which is essentially the combined portfolio of 500 largest companies in the US, right? And you invested it for 20 years. So you invested it in 2002 and held it until 2022. The first row, which says fully invested, is just you bought it in 2002 and you forgot it existed. You died for those 20 years, or I don't know, you just lost access to the internet or something like that. Somehow didn't know that you used to have $10,000 at some point. And then in 2022, you were like, oh, wait, I had those $10,000. Let's see what their value is now, right? And then you regain access to internet, you check, and there will be $64,000. If you did nothing, you just kept it there, right? Now go to the second row. This is, you didn't hold it throughout the period, and throughout those periods, it went up and down, and there were some declines and then recoveries and then growth and stuff like that, right? Now, out of those 20 years, you could accidentally miss just the 10 best days, right? Because you thought stock markets would decline, because of something that was somewhere in this graph, right? And you exited for a couple of days, and then you saw that, it's still rising, nothing bad, so I'll buy back, right? So if by these speculations you miss just the 10 best days, and imagine how small of a portion that is. How many days are there in 20 years? Probably a lot, right? 10 days is nothing. It's a very, very small percentage of that long period. But just 10 best days would cut your final wealth down by half, more than half, right? That's insane. Just 10 best days. And the more best days, still 20, 30, 40, that's a very small percentage of 20 years. You can end up even losing money, like having less than 10,000. So what happens oftentimes to people when they try to be smart about where the market will go in the future is that they just miss the good days and then they deprive themselves of returns, right? And deprive themselves of their cut in the rising profitability of companies. And that is also more generally illustrated in this chart, right? The greatest enemy of investors is usually their own behavior and trying to be smarter than the big players in the market about predicting what will happen in the future, right? This chart comes from a study by a company which is called Dalbar. They publish this study on a regular basis. And the reason it is interesting is that this company has access to actual investment accounts of ordinary people, right? Actual investors. And they can compile data sets based on it. So because they have access to these data and access to these to the value of these accounts, they can sort of pick a representative sample and get a very good idea of how much an average investor earns. And these investment accounts, of these ordinary investors, usually people don't just hold assets there, buy and do nothing for 20 years. Usually those are the kind of people you see on social media, right? So those who try to predict the future, analyze graphs, think whether the next couple of years will be owned by energy or technological companies, trying to find the stock that will be the next Bitcoin, right? Trying to earn a lot of money by being very speculative and trying to predict the future correctly, right? So those are those types of people. So those who are more aggressive in their investment approach, they try to be correct. They try to pick the winning investment, right? And usually you can see that these average investors are the column on the right, right? So they earn 2.9%, which is not much. That is usually just barely to cover inflation, right? Whereas in the left part, you have the S&P 500. And what the S&P 500 is you didn't speculate which companies, which sector, or which stock will be the winning one. And you didn't try to predict what will happen in the future and, buy and sell based on that, trying to sell before declines and then buy when you think the markets will rise and similar things. What you did there is you just bought the 500 largest companies in the US. So you essentially bought the entire market, right? In that portfolio, you had almost all you had all economic sectors included, right? So you had technology companies, but you also had energy utility companies. You also had pharmaceutical companies. You had car makers and similar things. So many different types of companies. You had large companies, you had smaller companies, and you didn't speculate which of those companies will be most successful. You didn't speculate whether their prices will rise or fall in the upcoming couple of months. You just bought all of them and held them. And because the combined value, the combined profitability of all these companies is rising in the long run, you benefited from the social progress, right? And from the progress the economy is making, right? You essentially bought the entire economy and profited from the economic growth that affects the entire economy, right? And you can see that paradoxically, this being, intuitively a stupider approach because you just buy everything and don't think about it. Paradoxically, this approach would have made you much more in those 20 years from 2001 to 2020, right? 7.5% per year. That's like an average per 1 year of those 20 years. So it's like earning 7.5% in each of those 20 years compared to 2.9% for an average investor. So usually when ordinary people try to predict the future and be too aggressive with their investment style, they make mistakes. And that's normal because we humans, we are emotional beings. We don't always process everything rationally. Sometimes we react out of greed or out of fear of missing out or out of fear that the media are writing that there is an economic catastrophe, right? In the same manner, we don't have good information always. Ordinary people don't have access to information with such high qualities as some investment funds on Wall Street, right? So they can game us and they can, they can win. So when you try to be aggressive, more often than not, you would make mistakes and lose money, right? What you can do is take the more relaxed or passive approach, and that is just buy the entire economy and don't try to earn money by being right about what will happen in the future. Try to earn money by just, having a share in the rising profitability and in the economic growth of the entire society, right? And that's an approach that comes with less stress and less option and fewer options to make mistakes, especially if you don't panic if there's a crisis and a decline happens and just are patient enough to wait for the recovery, right? And that is the philosophy of passive investing, right? And that sort of comes back to the analogy that I started this webinar with, right? I was talking about two types of tennis players, those who are professionals and those who can afford to sort of be more strategic in their placing of the ball, and those who can be more aggressive in the way they try to attack the enemy and outsmart them, right? That would be more like active investing. So active investing means that you do two things. First of all, you try to pick the stocks of those companies that you think will be the most successful and avoid those that will not be as successful, right? So you try to predict which company will be the next Nvidia, or Tesla before that. You probably heard that these companies were like super successful. They rose by many percents their stock prices. So when you do active investing, you try to identify which of those companies will there be in the future, right? And also what you do, so that's the first thing you do when you invest actively. The second thing you do when you invest actively is you try to predict what will happen with the markets, right? So will they go down or up in the upcoming couple of months? And if you think they will go down, you will sell and wait until the decline happens. And if you think they will go up, you will try to buy a lot, right? So that you can benefit from it. So when you invest actively, you are very aggressive, you think and strategize a lot, and your success depends on whether you can be correct about what will happen in the future. Whereas passive investing is the more relaxed approach where you try to sort of lean back and avoid making mistakes, right? Avoid making an unforced error. That is more, like when two amateur people play tennis on a Sunday afternoon. And when you invest passively, you just buy the entire market. That is, you try to buy all companies that are out there from all sectors. So you have pharmaceuticals, you will have car makers, but you will also have innovators and technology companies and green technology companies and similar things. So you will have all economic sectors, and you will also try to buy them from different markets. So I was showing a lot of US data here. This is because they are accessible there, but you absolutely shouldn't invest only in the US. You should also invest in European companies, in Chinese and Indian companies from emerging markets, in Japanese companies, essentially hold most of the regions that are out there in the world. And when you just have this, you just buy it and you hold it whatever it takes. You just hold it for decades and then benefit from from economic growth and rising corporate profitability in the long run, right? The catch is you have to do this over very long periods, because if a crisis happens in the meantime, you will just have to wait for a couple of months or even a couple of years until it recovers. That is why at the beginning of this presentation, I said that investing in stock market is suitable only if you intend to invest for at least 10 years, preferably even longer, for some goals such as retirement throughout your productive life for several decades, right? That is when stock market investing is their most reasonable option because it brings higher returns, but you will have to wait and wait a lot for many recoveries because declines will happen on the way, right? So that is the philosophy. And you probably noticed from this presentation that we at Finax think that for ordinary people, passive investing is the most optimal approach. First of all, because with active investing, they wouldn't make money anyway. They would very probably be wrong about their predictions of the future. And this is not just the case with ordinary people, but also with professional investment managers. In the bottom left corner, you can see a study or a result from a study which is called SPIVA. It's composed by S&P Global. That's the same company that is, in the S&P 500 name. And so S&P Global, every half year, they compare the performance of just the stock market. So that's, that's just holding those largest companies from all countries and all sectors in the world and not doing anything with them, to the results of actively managed mutual funds, right? So mutual funds are those things that they sell to you in the bank, where they have a studied, well-paid investment professional who is picking stocks for you and is trying to, pick the winners and be correct about the future by analyzing graphs and running numbers and stuff like that, right? And what they find in almost every issue of this study is that most actively managed mutual funds in banks earn less when you subtract all fees than the market. So if you just held the market and did nothing, you would earn, in most cases, even more than those active managers. Yes, there is a very, very small percentage of them who can earn more than the market. Those are the professional top tennis players. The problem is it's very difficult to say in advance which of those investment managers will turn out to be the most successful, because this also changes a lot. Investment managers that used to be successful in the past are generally cannot sustain that performance into the future, and some new rising stars replace them. So, if you just want to be sure, the best thing is not to try, to speculate and game the market. The best thing is to make it your friend and to just buy it and benefit from economic growth, right? So now, if you are convinced that passive investing is good, and yeah, that's advantage number one. But advantage number two of passive investing is that it takes zero time to do, right? You just find a passive investment provider, you set up a standing order from your account so that money would get invested automatically every month, preferably like a couple of days after your paycheck arrives, and you can forget about your money for 35 years. And that's all it takes. And you can focus on your job, you can focus on your hobbies, you can focus on your family. You don't have to spend time, thinking about, which company will rise and which will fall, right? And you don't have to stress that much. Because if you invest actively, it comes with a lot of stress. Like, have I bought the correct stock? What if the markets will decline, right? I have actual stories of my colleagues who used to be like active traders, like being more aggressive in their investment approach. And they said that the top disadvantage of that approach was that it was very, very stressful and required a lot of time of them. And they didn't want to do that. They wanted to spend their life doing, work they found meaningful and hobbies they found meaningful, or being with their family and relaxing, and waking up at 3 a.m. to check how the markets in Asia are doing because you have money invested there and you want to sell it off if they're doing bad. That doesn't sound like peaceful life, right? So another big, big advantage of passive investing, probably the best one, is that it's comfortable. It doesn't require you to stress much, and it doesn't require you to spend much time analyzing mathematical charts, right? And that is important because it literally requires you to forget about your money and set up a standing order. And that's the best thing you can do because you will ignore declines and won't be able to panic in that case. So that's a very big advantage. So now, if that convinced you, and okay, passive investing, that sounds like the convenient thing for me, then you might be asking how to invest passively, because I told you buy the market, buy all the companies there are in the world. But that's a lot of companies. How do I do that? How do I even decide how many there are and everything? And for that, the best tool are usually so-called index funds. Index funds essentially buy almost all companies in the world, right? Or in a given market. What is an index? An index is a large group of companies that essentially represent the most companies from that given market, right? So imagine imagine it like this. When they are collecting voter preferences before elections, right? So they want to get an idea, those polling agencies, they want to get an idea of how people will vote in the next elections. What you could do is ask everyone who lives in the country, but that would take ages and a lot of money, and no one wants that, right? So what they usually do is they select a representative sample, right? This representative sample will usually contain people who are different, right? They will want to have all age groups represented. They will want to have people from different regions represented. So those living in larger cities and those living in villages. They will want to have people of different sexes, genders represented, and stuff like that, right? So you will want to have a lot of different people so that collectively they roughly represent how the population of the entire country is composed, and they just ask those people and get an idea of how the entire country will vote. An index is something similar. So an index is a group of companies that are different and sort of represent all the companies in the market. So you will have pharmaceutical companies, you will have energy companies, but you will also have technological companies and defense companies and car makers and stuff like that in that index. So companies from different sectors of the economy, also companies from different regions, from richer parts of the country, from poorer parts of the country, from different countries within the region, and so on, right? So, for example, the way you can do this in the United States of America is that in the US, you have roughly 6,000 companies that you can invest in. So 6,000 companies that are traded on exchanges and people can buy their stocks. You can compose an index by having the S&P 500, which is 500 largest of those from different economic sectors, right? Um, so those 500 largest companies, because they are large, right, will represent roughly 80% of the value of all companies in the United States, right? And they will have all sectors represented, which means that they will be representative of the broader market. And you can invest in those 500 to sort of get an exposure towards all sectors and all parts of the United States of America, right? But you don't have to limit yourself to America, right? There are indexes from different regions of the world, right? So you have indexes of the US, you have indexes of European stocks from the entire Europe, and there you will have different sectors, but also different countries. You will have UK, France, Netherlands, you will have Nordic countries, you will have Italy, and so on, right? You can have emerging market indexes, which are from countries that are still sort of not classified as like super poor developing countries, but that have economies that are still developing to an extent, right? They're rising. So emerging market indexes contain stocks from China, from India, from Brazil, and similar countries, right? You can have Asia Pacific indexes where you have Japan, Taiwan, Hong Kong, and similar countries, right? So you can get indexes from various parts of the world. Now, the question we often get is, and this has been, this has been a question we've been bombarded with since we were founded, and that is, should I invest in the entire world? Isn't it enough to just invest in the legendary S&P 500, right? So in the companies in the stocks of the United States. Now, the reason we were asked this question is because before Trump came into the office for the second time, which sort of is changing this dynamic. Before that, US stocks used to be very dominant in terms of the profits they were bringing, right? So if you invested in US stocks, you would earn more than by investing in different regions of the world. And they have been very dominant for, let's say, the entire decade, like since 2012, let's say, until 2024, 2023, US stocks definitely were the most successful region in the world. So people just looked at those profits and were like, hey, this is earning a lot. Why should I invest in anything else? This clearly is a better thing. And what I want to do in this slide is to tell you why that's not a good idea and why no. You shouldn't invest only in the US. You should always, when you are investing in stock markets, include stocks from the entire world, right? So have indexes from US, but also from Europe, from emerging markets, from Asia, and similar things, right? All the regions that are there in the world. The reason is that you never know where growth will appear, and in different periods, different regions are dominating in terms of profits. So the last decade was dominated by US stocks, and that is fine. But let me tell you a story. This story was told to me by my boss, who has been in the financial markets for almost 20 years now. And he was starting in 2006, so before the global financial crisis of 2008, right? And what he told me was the general environment in 2006 was what you can see in the picture in front of you, right? So you can see that between 2001 and 2010, US large cap stocks, which is like the missing spike in the very left part of the graph. So that's the S&P 500. Those are the super successful US companies that have been dominating in terms of profits in the recent period, made a return of 0% in 10 years. They earned, imagine earning nothing in 10 years. That's like very frustrating. This is because there were two crises that hit large US stocks a lot. There was dot-com bubble in 2000, and then there was the 2008 global financial crisis that also originated from the US, so US stocks suffered the most from it. So in those 10 years, 0% in US stocks. It was the so-called lost decade of the United States, right? Because they earned nothing in 10 years. In the same period, so in the same 10 years from the beginning of 2001 to December 2010, emerging market stocks rose to more than 5 times their original value. So they rose like crazy. They were absolutely dominating in terms of profits. Now, emerging markets mostly were dominated, like all this profit originated in a group of nations called BRICS. So that's Brazil, Russia, India, and China. They were growing a lot. China joined the World Trade Organization in 2001, so started trading more, started economically developing rapidly, right? And similar in those other countries. So they were the kings then, and they rose like crazy, right? While the US earned nothing and was struggling with crises. And so what my boss tells me is that in 2006, when he joined the global financial markets, no one was talking about investing in the US. Everyone was crazy with BRICS, and they were saying that you should invest all money only there and ignore the rest of the world, ignore the US, ignore Europe, right? And it was easy to justify back then. They were creating stories such as, look, developed world is already developed. There's not much place to grow anymore, right? We already have everything. We are already rich. Not much more space to become even richer. We also have very bad demography. Not many young kids are being born. We are aging. So, Europe, US, developed markets, they are lost. The future is not theirs. Where the future lies is those countries that still have plenty of room to grow, have a lot of kids being born, a lot of future workforce, like economic growth will happen there, right? So ignore developed world, invest most of your money into BRICS funds. And he told me that like BRICS funds that were investing in these countries, in emerging markets, had largest inflows. People trusted them the most, right? So yeah, when you take this graph and when you examine how much these different regions of the world earned from, January 2011 until December 2020, what do you think would be the result? Do you think those people who were investing in those emerging markets were correct? Well, the answer is no. Those US companies that earned nothing in the previous decade suddenly became the most dominant in the world because very powerful technological companies that brought a lot of innovations and earned a lot of profits emerged there. Meanwhile, Chinese government became very restrictive when it comes to their billionaires and when it comes to the way in which their companies could operate. They were making a lot of crackdowns because they were feeling threatened by the business sector. So China started struggling, right? And emerging markets actually earned the least from all the regions in the upcoming next decade that came after that. So although everyone expected them to remain the winners, they actually were the losers of the global race. And the winners were previous, past losers. So the US suddenly woke up and earned a lot over the next 10 years. So this illustrates a nice story, right? You never know which region will be the winning one in the next decade. Many times markets surprise you genuinely. And although today you will hear a lot of convincing stories saying why the US dominance will continue, it's not guaranteed. And yeah, in the future, US can continue to outperform other regions, but it can also happen that the dynamics reverses. And it sort of shows since the beginning of this year. So I don't know if you follow what is happening in the global economy or in the markets, but Donald Trump has gone nuts since taking office, imposing tariffs there and there. And that makes the US companies pay the highest price, right? So since the beginning of the year, the US is actually the region where stocks decline by the most. Compared to that, Europe or emerging markets are doing slightly better than the US, right? And also the talks about how Europe now needs to invest more, both into its defense, but also into its general internal market and its own companies, because it needs to be more self-sufficient from the US. That actually caused some initial optimism among investors in saying that Europe finally could be more self-sufficient and might have more economic growth here because we will be investing more, right? And stuff like that. So, things can happen, things can surprise you, and it's best to hold all regions because only by holding the entire economy of the world, you are guaranteed to always hold the winners and never miss out on them, right? So only by holding everyone, you will also have winners in your portfolio, and you will have the Chinas and the United States and the Nvidias and the Teslas of future somewhere in your portfolio and benefit from the innovations they bring and from the profits they make, right? Now, one of the last slides here is, okay, I want to invest in these indexes, right? How to do that? So there are several tools with which you can invest in stock market indexes. The best ones, in our view, are so-called ETFs. So ETFs are exchange-traded funds. These are things that you can normally buy on a stock exchange, just like normal stocks. And ETFs are usually funds, so, large pools of money that contain the companies that are included in indexes. So if you have an ETF that is tied to the S&P 500, that ETF will invest in 500 largest companies in the US. You will just invest in them by buying an ETF. You will own a small fraction of each of those 500 companies, right? And these ETFs just hold those. So you can just buy an ETF, have those 500 companies there, then also buy ETFs from other regions of the world, right? So you should have an ETF for the US, an ETF for Europe, an ETF for emerging markets, and similarly. And you can just hold them for many, many, many years and just hold them and do nothing about it. The advantages of this is, first of all, higher returns. This is because investing via ETFs eliminates emotions and judgment from investing, and emotions and judgment, trying to predict the future, leads to investment mistakes. Liquidity just means that it's easy to get the money if you want it, right? Compare that to, for example, investing in real estate and houses, right? If you invest in those, it's not very easy to get the money when you need it because, first of all, selling a house takes a lot of time. But also, imagine you only want a portion of that money. So you have a house and you need 10,000 or 15,000 euros because your kid is going to college or something like that. It's very difficult to just sell the bathroom, and keep the rest of the house. You probably can't do that. So with having financial wealth in ETFs, you can just sell a bit of the portfolio when you need some money for renovation or for college or whatever, or when an emergency happens, some tragedy and you need a lot of money, it's easy to get it quickly, not wait months until you find a buyer for your house or something like that, right? So financial wealth is easier to access, and that's a big advantage compared to, for example, real estate or something like that. Also, a big advantage is that you have diversified risk. I already said that in many indexes, you have like 500 companies. If you buy indexes from the entire world, so also have Europe, emerging markets, China, and so on, you will have thousands of companies, right? So for example, at Finax, we have stock portfolio that invests in ETFs, and there are more than 7,000 companies included there, right? That's a lot of companies, and that's an advantage when it comes to risk, because if something happens to one of those 7,000 companies, such as it goes bankrupt, like completely. It turns out it was an accounting fraud and everyone gets jailed, and the company just disappears from the world. You won't even see it on the value of your portfolio because it's only a very, very small portion. Whereas if you invest, in those aggressive styles where you maybe select the top 30 companies that you think are the best in the world, if something happens to one of those, that can hurt you a lot and cost you a lot of money, right? Here, the risk is spread out among many, many, many companies. Another advantage of ETFs is that because they're so easy to make, right? You just have to check what 500 companies are in an index and then buy those companies and then do literally nothing. And then after a couple of months, you check whether all those same companies are still in the index and adjust if any changes were made. But it's relatively easy to make ETFs. That means they don't cost a lot, right? So you usually pay much lower fees for your investment when you invest via ETFs passively, right? For example, for mutual funds, where you need to have those analysts that analyze your charts and those portfolio managers who are well educated, very well paid, and are supposed to take care of your investment, that is more expensive because you need to cover the salaries of those people and all the technology that is needed to make predictions about the future, right? So there you will pay much more, and a penny saved is a penny earned, as they say. And in Slovakia and Czechia and also Croatia, a very, very important additional reason is that ETFs are free from taxes on investment profits. And that's super important. Usually, whenever you make profits with your investing, you earn some return, you have to pay around 19% of that to the government, right? So that's a fifth of your investment returns. And that can be a lot. If you genuinely keep discipline and invest throughout your life, you can have tens of thousands of euros in profits. So taking a fifth of that is a lot of money just to give to the government. In Slovakia and Czechia, we have incentives that say if you invest for the long term, so if you hold these ETFs for many years, you can pay zero tax on your investment profits. In Slovakia, this is after 1 year of holding. So all you need to do is to buy an ETF and hold it for 1 year, and you don't have to pay any tax. In Czechia, it's after 3 years of holding. So buy an ETF, wait 3 years, and then you don't have to pay any tax. But this can be a giant saving. And again, a guaranteed saving. By speculating about the future, you're not guaranteed to be correct. But by saving on fees and saving on taxes, you are guaranteed to keep more money. And that's always smart, right? This is last slide, and it sort of combines what we learned in the past to what we learned today, right? So in the last lecture, we were talking about how to be good savers. So how to save, how to save a large portion of your monthly income, right? So that was moving from the left sides of this table to the right side of this table, right? In the left side, you maybe save 2% of your salary. In the right side, you save 20% of your salary. What we learned today is how to be smart investors. So how to consistently earn returns that are expected to be above inflation. Now you remember those charts of the U.S. stock market as it was rising over the 200 years, right? As I showed you. So usually when you examine past data, you find that the global stock markets usually make profits of roughly 8 to 10% per year, right? So that's the bottom three rows of this table. Of course, that is not guaranteed into the future. As I said, past things and past information says nothing about the future value of companies. But it's reasonable to expect that it might be somewhere close to that. Maybe in a pessimistic scenario, maybe closer to 5 or 6%. But you will be probably towards the bottom half of this table. Now combine that, right? So combine 20% savings rate with an annual income of 15,000 euros. So that's not insanely unattainable for many people, right? It's not like this is a rich manager of some company, right? It can be an unimaginable income in our countries. So combine 20% saving rate, so being able to set aside 20% of your annual earnings each year with like a 7 or 8% return in the rows, right? You will see that the final wealth after 30 years of investing, so that's, let's say, a standing order set between the ages of 25 and 55, right? And forget about that standing order existing. The expected value of what you could get is more than 300,000 euros in an investment account somewhere when you are 55, right? That's just unimaginable for people. That is like unintuitively large amount, right? Just imagine how many of your life problems would get easier if you had that amount of money in your account. And that's not just for greed's sake. You could do charity. You could be very, charitable to people. You could support your kids so that they don't struggle with buying their own housing. You could give away. You could have decent retirement without worrying about being in poverty and similar things, right? If your kids wanted very, very good education, you could buy it for them. It's like it opens up freedom to do whatever you consider meaningful much more, right? And that's what I wanted to have as the motivating dot at the beginning of at the end of this presentation, right? So these amounts in hundreds of thousands, they are not just for the most successful entrepreneurs or for most successful businessmen or rich managers. People with regular incomes can work up to them, but they need to be very, very patient and disciplined. So they need to invest in stock markets, do that every month, and do that for decades, right? So just somehow set up a standing order and forget about it, and then it can be realistic. But that's easier said than done, to be fair. But if you manage, you can have close to these amounts, right? Okay, so that was a motivating note towards the end. Now, to essentially, one last thing to say. Thank you very much for your attention. That is everything that I had prepared content-wise. Now we can do two things. If you can, and if you still if you still have a tiny bit of energy left at this ungodly hour, we would appreciate if you left us feedback. So if you scan this QR code, it will take you to a feedback form. You can switch it into English. The initial language that will appear is Slovak. I believe many of you speak Slovak, so you can either use that, or you can look into the into the top right corner of that form. There will be an option with a little arrow to switch languages from Slovak to English to get into the English version of that form. You can tell us how you liked it. You can suggest improvements. A lot of these topics were created by listening to feedback from people, so we will be very, very happy to hear from you and hear any suggestions on what you didn't get and what you would like to add for the future. And yeah, while you are doing that, if you have any questions, I'm happy to answer them if there's still if there's still some energy for that. But besides that, yeah, thank you for your attention very much. I see that we probably don't have any questions. So I'll just leave this, form on the screen for a slightly longer while so that those of you who are interested can scan it. And if you are done with that, then I won't hold you any longer. Thank you very much for staying throughout this presentation. I really appreciate it. I understand that it's late and that it was a lot of technical information probably. So thank you for staying. And if you're done, then good night. And I'll be looking forward to seeing you at our next lecture about pensions, which will be about the retirement system and everything. So yeah, thank you and good night.
Thank you so much. Have a good night.
Thank you.
Thank you.
Thank you. Good night.
Thank you. Bye-bye.
Bye-bye. Good night.